Yeah, I will do it today. Chapter 4, 5, 6. I'm planning all Sheikha today to upload the remaining chapters. 4, 5, and 6. We have 3 chapters. Okay, now today what we will discuss? What is in chapter 4? What is new? Remember when I start chapter 2, I just give a short view of 4 chapters in front of us. 2, 3, 4, 5. 2, it was basic. 100% owned enterprise and without differential, how we do the consolidation. The last chapter, chapter 3, we learned non-controlling interest, right? What is non-controlling interest? If a company acquire 70%, 60% of another company, so the remaining 30, 40 will be non-controlling interest. So if there is non-controlling interest, in the consolidation, we have to show 2 accounts. What are they? Non-controlling interest in net assets, it's in balance sheet. Non-controlling interest in net income, it is in income statement, remember? So, first 2 chapter, we didn't have differential. But this one, chapter 4 and 5, we will have differential. What is differential? Do you remember? What is goodwill? What is excess value? What is differential? In the first chapter, second chapter, we discuss about that. Especially when we do some external expansion. When you acquire a company higher than its fair value, there was a goodwill, remember? You don't. But it was the first assignment, you did it. Yeah, I remember. Even maybe in the quiz, I don't remember, but so you should just check your previous notes. But the issue is here today. We will also talk about it. Don't worry, and I will explain it once more. And after this, chapter 4 and 5, we have a lot of examples, so you should know it. But the issue is this: if a parent company acquires a subsidiary, okay, in chapter 4 we assume 100%. Okay, chapter 5 we will combine this differential and non-controlling interest together. But today, we will talk about consolidation of 100% owned subsidiaries, only owned subsidiaries, okay? And it is acquired at more than book value. More than book value means there is differential. So what is differential? When we talk about, acquisition price, this acquisition price, what the parent company paid for the 100% of these common stocks, correct? For example, the ABC company paid $1 million to buy a company's 100% shares. But when you look at the other company, XYZ company, the balance sheet of that company, I look at the balance sheet, liabilities and assets, and I calculate the net assets, and I see that it is 800,000. Okay? The company's balance sheet shows me that company's net asset is, but book value of net asset. Because in the balance sheet, what is written is book value, right? In the balance sheet, what we see, book value, okay? What we pay, acquisition price. That is called fair value consideration given to the company. Because we think that this company worth 1 million, but according to book, 800. Why is this difference? Because this records, some of them, old, actually all of them historical values. So some maybe value of some assets or liabilities increased or decreased. What we call it? Fair value difference, right? For example, a building. Buildings fair value, let's say, increased. Land's fair value increased. But on the other hand, inventory's fair value is less than book value. It can be more or less, but the general total fair value of that company may be higher than what is written there, because it is historical value. So 800 written, right, in the balance sheet. Assume that fair value of the company is 950. Okay? 150 more. What do we call this 150? What is the difference between fair value and book value of the company's net asset? This is called excess value. Okay? Excess value. What's excess value? Difference between fair value and book value of identifiable asset. Each asset we compare. We compare cash, okay, receivable, inventory. Oh, inventory is different. Okay, this is the difference. Building, equipment, we see difference. Okay, liabilities, we see difference. Whatever we see difference between book value and fair value is called excess value. Look, 800 is the book value, 950 is the fair value, but how much you paid, remember? 1 million, more than that. Even the fair value of the company is 950, I paid 1 million, 50,000 more. What is that? Goodwill, exactly. That is goodwill. So we have excess value between fair value and book value. We have goodwill, difference between acquisition price and the fair value. And the overall differential, what is the differential? 200. 200 is the differential, 150 excess value, 50 is goodwill. So this is in reality, because when you want to buy a company, for example, if I have a company and the book value is 800, why do I sell it for 800 if the fair value is 950? I at least ask 950, right? Because if I want to sell this company, liquidate and sell in the market, I can get that money. Why I sell them at that? And then another thing is you are selling a complete company. So there is no difficulty for them, just the transfer is very easy. So I am not selling building equipment separately, everything together. And they will take the shares and they will be the owner. So I ask more. If I expect more on this company, if there is a future for this company, I ask more than the fair value because I'm losing some opportunity to earn. So it's the subject of valuation. We call it valuation. In the financial statement analysis classes, in capstone classes, you are learning this valuation. So the person or the company wants to buy another company, make a valuation, and based on that, they say that, okay, I can pay $1 million, even it is 800 written there. Why? They look to fair value, they look to opportunities and other things. Then, based on that, they pay this money. So if they pay this money, what is my investment account? Investment in subsidiary. How much do I debit? 800, 950, or 1 million? 1 million. Why? Because how much is the cost of this investment? I record in my balance sheet as investment, $1 million. Okay? Because how much I paid, this is my cost. So in the balance sheet, parent balance sheet, when they pay $1 million and get the 100% of share of other company, they record as debit investment $1 million, credit cash $1 million, or bonds payable, or shares, whatever the payment method. But the investment should be $1 million. Clear? Okay. So when you make the consolidation, okay, parent, subsidiary, we are making consolidation, right? Okay, when we do this consolidation, $1 million investment one side, but the balance sheet of other company is net book value is 800. Is that correct? 1 million here as an investment, but all companies book value 800. So when we are consolidating two statements, there will be 200 difference. So where we will write this 200 difference? Okay, 150 is because of excess value, right? Excess value of, let's say, only one account, let's say land. Nothing else, only land is more valuable, 150. So when we are making the consolidation, land of parent, land of subsidiary plus 150 because of the excess value. So the consolidation, we will add the excess value of length to the total amount. So consolidated balance, okay, that 150 is offset. What about 50? We will add a new account that is called, yes, goodwill. So that is the account we will add. What's happening? Okay, so in the consolidation, we have to add this fair value differences and we have to add goodwill. So what do we need? We need additional entry. So for how many consolidation entry you have learned? 2. Basic consolidation entry and accumulate depreciation entry. Okay, you didn't learn, I think. I said you learned, but you need to learn then, please. Okay, this is consolidation. I mean, 3 weeks we've been discussing about. Still we continue. So this week, please, when I upload the slides, study on them, look at the book, and then, because this is all connected, the previous chapters you should be well know. So if you know them well, then you can do it this better. So we have 2 consolidation entry. One is basic consolidation entry and accumulate depreciation entry, right? Now we have 2 more. What are 2 more? One is obviously about this goodwill and excess value, right? Because we have to add them. What is the other one? What's number 4? Now think about that. For example, excess value is about land, I said, right? If it is not about land, let's say it is about equipment. So you are adding 150,000 to equipment, okay? Because we are adding that value, increasing, right? But equipment, that part of amount is not depreciated. Normally, we are calculating depreciation for the equipment, right? So based on that, we record depreciation expense. So if there is some increase in some value, some asset, only increasing the value of asset is not enough. What you should do? You should look at that if there is any effect on the expense as well. Because since it is more valuable, so we have to record more cost about that. For example, if the equipment, let's say $200 and 10 years is depreciation, every year we record 20, right? But if it is not 200, but if it is 350, so how much I should write every year? 35 instead of 20. Do you understand my point? Can you follow me? Assume that equipment is $200,000 and the economic life is 10 years. So 200 over 10 years. Richard, I am not explaining from the slides. I'm talking about in general. If you cannot follow me, you can ask me, okay? Just I am explaining in general, just making an introduction. I'm not going through the slides right now. Just I am explaining how the differential affecting, okay? So, let me continue then. Equipment, let's say $200,000, okay? So 10-year life, it means every year 20,000 depreciation expense should be recorded, right? For 200,000. But if it is not 200, because of the excess value, this fair value, it is 150 more, I mean 350. So you should allocate $35, not 20. So $15 depreciation, because of this $150 excess value, occurs. So this amount should be recorded as an expense. So in the consolidation entries, we have to add 2 more entries. One, to show the increase in the value, fair value difference, and goodwill. And the other one, what is the effect on the expenses? Okay, so these 2 entries will be added. So in the consolidation, we have to do some additional thing. That is what we will do. I just shortly explained. Now let's go through the slides. So the main issue here, parents' book reported investment at acquisition price, that is the fair market value consideration given to that. But when we look at the subsidiary, everything according to what? Book value, right? Because subsidiary itself doesn't make a change. But when I write as a acquisition, I write investment at fair value, $1 million, not 800. But all the amounts in the subsidiary is still at book value. So this difference should be, eliminated. So we have to look at the excess value in any asset. If equipment's fair value is high, then we should record it. If inventory is high or low, we should record it. Patent, intangible asset, we should. Goodwill, we have to calculate and write. But after writing, there is second problem, second issue we have to solve. I told you, if the equipment written as 200, depreciation is recorded accordingly. But if it is 250, depreciation should be more. If more value, expense will be more. So if equipment value, we will do some increase in the value of equipment, we should increase the depreciation expense. What about the other accounts, related accounts? If we are talking about inventory value, if it is merchandising company, we are talking about, or finished goods in the manufacturing, we should talk about cost of goods sold. Because inventory, if inventory is high or it is understated, so this cost of goods sold is all understated. So these accounts, if there is an increase in the intangibles, we should increase the amortization expense. For inventory, related account, goodwill, cost of goods sold. For goodwill, we have to calculate the impairment loss. Actually, not calculate, but it is tested by the management. So if these assets are understated, it means book value is less than fair value. So all of these expenses are understated. So if these expenses are understated, so revenue, okay, not revenue, operating income, profit is understated or overstated. If expenses are understated, so profit will be overstated because we are not showing the expenses. So profit is more than it should be. So if expenses are understated, you see here, and then income is overstated. So in the equity method entries, remember, we have how many equity method entries? 3, remember? What are they? Three equity method entries: acquisition, net income, and dividend, right? We have 3 equity method entries. When you are recording the investment in the journal entries, we have 3. What are they? Acquisition, dividend, and net income. Now, in this case, in this chapter, we will learn one more equity method entry. It's about what? Overstated or understated income. We should adjust this income. So income adjustment. So we will add 2 entries for consolidation, 1 entry for equity method. Okay, 2 entries for consolidation entries. We have 2, it will be 4. Now equity method was 3, it will be 4. So equity method entries will be 4. Consolidation entries will be 4. In chapter 2 and 3 equity method entries, 2 consolidation entries you learned. Now we will add 3 more entries today we will learn. What is it about? Adjustment of income. What is this about? Excess value reclassification, adding this excess value, and showing the amortization of excess value, this recording expense relating to this assets, depreciation, cost of goods sold, amortization, and others. Okay, so Dua, 4 equity method entries and 4 consolidation entries today we will do. So the topic of differential, what is goodwill, what is excess value? Okay, let me start with this example then. Can you see well? I think so. This a bit. Okay. Maybe it's better me to share slides. On the slides, it's better maybe to go. All right, it's okay, same. So let's go with this one. Okay, Ajax company purchased 40% of the common stock of Barclay company. So this example is about what? Equity method entries. It's not about consolidation. Why? Because consolidation is needed when? If it is more than how many percent? 50%. So first of all, we will discuss about the equity method entries, how this adjustment, what is it about? Income adjustment, right? Equity method about income adjustment. How do we calculate the amount to be adjusted? Okay? And then later I will solve some questions about consolidation as well. But this question is limited with the first part, equity method entry, that is the adjustment of income. Ajax company purchased 40% of common stock of Barclay company January 1st, 2011 for how many dollars? $200,000. So $200,000 is the, just a bit shifted on the right. So let me better to show here. Okay, because it shows exactly where it is. Okay, now this is 40, this is 100, you can see that. All right, $200 is the, what is this? Ajax paid 40% of Barclays shares. This is the acquisition price. So 40% of, they paid 200 full. If they want to buy 100% only, they have to pay 500. Normally, the value of the Barclays share is 500, okay? But they bought only 40%, they paid 200. So Barclay has net asset of, at the date, on the date of this acquisition, book value 400, fair value 465. So can you see these numbers? Is that clear for you? Okay. So this 400 is the book value, 465 is the fair value, 500 is the acquisition. This is for full 100%. Okay? You remember this one? We discussed about that. Do you remember this? Book value, fair value, acquisition, excess value is the difference between fair value and book value. Goodwill is the difference between acquisition price and fair value. Okay? So this side shows the total amount, total 100% of the company. But if we are talking about Barclay sorry, not Barclay, Ajax, the company who's acquiring this Barclay. So the acquirer paid $200 for the acquisition. 40% of the book value of those shares is 160, you see, and then 200 acquisition price minus 160, total differential is